If you are self-employed and still think your biggest tax problem is a lack of clever write-offs, you are staring at the wallpaper while someone installs a toll booth on your highway. That is the brutal truth. Most people do not lose control of their tax bill because they are lazy. They lose control because they are fighting the wrong war. They keep shopping for shiny deductions, trendy entities, and cocktail party tricks, while the real meter is already running every hour they work. I have spent my life studying how money moves, where it leaks, and which incentives quietly eat people alive. And I will tell you something plainly, the self-employed do not usually get crushed by one spectacular mistake. They get crushed by misunderstanding the road they are on. You think you are building independence, you think you are escaping payroll, you think you are finally keeping the whole pie. Then April arrives, the return gets prepared, and the government hands you a number that feels like an insult. You stare at it and think, this cannot be right. I did not make that much. Why does it feel like I am being taxed like a criminal? Because you were never driving on a free road, you were driving on a toll road, and nobody taught you where the gates were. When you are a W-2 employee, the toll is still there. It is just quiet. Half of it is hidden from your eyes. The other half is skimmed off before the money ever lands in your account. The pain is numbed by automation, the check is smaller, but the system is smooth, and smooth things feel normal. The moment you work for yourself, the anesthetic disappears. Now the same road looks different. Now the toll collector steps out where you can see him. Now both sides of the payroll burden show up under your name. Now nothing is withheld in the background to protect you from the feeling. That is why so many self-employed people think they suddenly entered some evil tax bracket. They did not enter a new reality. They just lost the curtain. That is the first thing you need to understand if you want to stop bleeding cash with a confused look on your face. Self-employment tax is not some weird punishment designed for entrepreneurs. It is Social Security and Medicare tax. It is the same basic labor toll that exists for ordinary wages. The difference is that when you are self-employed, you are standing in both lanes at once. You are the worker and you are the business. You are the employee and the employer. You are paying the fare from both pockets. And that changes your psychology. A salary worker sees less money. A self-employed worker sees a bill. That distinction matters more than most people realize. Because once you see a bill, you feel hunted. Once you feel hunted, you start searching for escape hatches. Once you start searching for escape hatches, the internet starts selling you fairy tales. This is where the second injury begins. First, you get hit by the tax, then you get hit by misinformation. A man earns healthy Schedule C income and thinks real estate will solve it. He hears that rentals are tax magic. He hears depreciation is a miracle. He hears wealthy people use property to pay nothing. So he buys a rental, signs debt, absorbs friction, and congratulates himself for becoming sophisticated. Then he learns the hard way that he changed one tax story, not the one that was cutting him open. He may have added a useful asset, he may have improved parts of his income tax picture, but the active business profit that triggered the self-employment toll is still running through the same gate. The meter on his labor road does not care that he bought a duplex last quarter. Another person forms an LLC and feels clever for 48 hours. That feeling usually comes from confusing legal packaging with tax physics. An LLC may matter for liability, contracts, ownership, structure, presentation. Those things are real. Those things can matter. But too many people put a new label on the jar and think the liquid inside has changed. A1. Owner LLC does not become magical because a state filing says so. Ignore the online noise. A new costume does not change the tax engine. If the business remains the same active business in substance, the toll collector still recognizes your license plate. Then comes one of my favorite delusions because it sounds smart at dinner parties. A couple has one strong business and one weak business. One spouse produces meaningful profit. The other creates losses. They imagine the loss wipes out the self-employment tax on the profitable spouse. The language sounds tidy. The household lost money over here. So surely the household should pay less over there. But taxes are not a romance novel. They do not care that you are emotionally one team. On this issue, They ask a colder question: who earned the active income that triggered the toll? That is where self-employed people learn a hard lesson about system design. The tax is tied to labor income and the person producing it. Household storytelling does not dissolve that. One spouse's business losses may help with income tax at the joint return level, but they do not simply erase the labor toll sitting on the other spouse's active business earnings. So now you understand why so many self-employed people feel betrayed. They were told to chase deductions. They were told to buy real estate. They were told to form an LLC. They were told that any entity is sophistication. They were told that losses somewhere else would wash it all out. And then the road invoice arrived anyway. This is the part where most people turn emotional instead of strategic. That is expensive. Emotion makes you reach for hacks. Strategy makes you map the road. I do not want you emotional here. I want you cold. I want you exact. I want you to stop calling every tax idea a strategy just because it has a noun and a webinar attached to it. A real strategy changes the route. A fake strategy decorates the car. That distinction will save you years. Now let me take you one level deeper, because the hidden mechanism is where the real pain lives. Self-employment tax attaches to active income, not to vibes, not to identity, not to how tired you feel, not to how entrepreneurial your Instagram bio sounds. Active income, work income, labor, linked income, income generated because you are in the machine, pushing, producing, managing, performing. That is why the self-employed person feels squeezed in a way that investors often do not. The worker lives on the toll road. The owner tries to own part of the road. The investor earns from traffic without standing at the booth all day. This is one of the great dividing lines in finance: salary versus equity, labor versus capital activity versus ownership. If you do not know which side of that line your dollars belong to, you will keep using the wrong tools on the wrong problem. Most self-employed people are not actually in a tax emergency. They are in a category confusion emergency. They call active income passive because they registered a business name. They call a legal entity tax leverage because a YouTube clip told them to. They call any deduction saving on taxes, even when it does nothing meaningful to the toll they hate most. And because they do not define the battlefield correctly, they never see the few levers that actually matter. There are not many. That is another fact people resist. They want 7 tricks, 12 hacks, 1 weird loophole, and a secret banker number. They do not want the truth, because the truth is smaller, narrower, and less cinematic. The truth is that there are only a handful of genuine levers, and each one comes with conditions, trade-offs, timing, and substance requirements. That is why adults win and amateurs lose. Amateurs want slogans, adults want thresholds. The first real lever lives in a place most people will never stand, which is why I mention it not as a fantasy, but as a lesson in principle in certain limited partner situations. Part of the distributive share can be treated more like a return on invested capital than compensation for services. That distinction matters because a return on capital lives in a different neighborhood from labor tolls. Notice what is happening beneath the surface. The escape does not come from optimism. It comes from changing what the income fundamentally is. That is the whole game, not changing your mood, not changing your font, not changing your website header, changing the character of the income. But this is where foolish people hurt themselves. They hear limited partner and imagine they can wave a wand. They forget that substance matters. Legal status matters, participation matters, economic reality matters. If you are still functionally performing services and controlling the activity in a way that makes the income smell like compensation, you do not get to whisper the phrase capital return and walk through a side door. The road does not care about your euphemisms. The second real lever is the one every self-employed person hears about too early and understands too poorly. S-corporation, this is where the internet gets dangerous because it combines something real with something oversimplified. That is always the most profitable kind of bad advice. If the advice were completely fake, fewer people would buy it. The perfect trap is half true. Yes, the S-corporation can change outcomes. No, it is not a universal first move. And no, pay yourself 30% is not a law of nature. Let me tell you what is actually going on. In an S corporation, you wear two hats. One hat is labor, one hat is ownership. The labor hat must be paid reasonable compensation for the services you actually perform. That wage goes through payroll tax economically. That payroll burden is not some unrelated species. It is the cousin of the self-employment toll you were already complaining about. Different collection method, same family. Then, if there is profit left after paying reasonable compensation, some of that remaining profit may come out as distributions, not subject to payroll tax in the same way. That is where the real leverage comes from, not from pretending you do no work, not from starving your salary to absurdity, not from announcing yourself an owner while spending 60 hours a week as the operating engine. The leverage comes from one hard fact. Once the labor component is reasonably paid, excess profit does not always have to wear a labor label. Read that again, because that is where grown-up tax planning begins. Once labor is paid reasonably, excess profit does not always have to wear a labor label. But timing matters, scale matters, profitability matters, administrative cost matters. If you elect S corporation status too early, before the business generates enough profit to pay a reasonable wage and still leave meaningful surplus, you do not become sophisticated. You become burdened. You add payroll, compliance, filings, bookkeeping pressure, potentially state-level headaches. And you may discover that almost all the business income still has to be paid out as wages anyway. That is not planning. That is costume jewelry. A small business owner making modest profit can easily spend time, money, and attention installing a machine that produces almost no real savings. And now you understand one of the cruelest patterns in personal finance. People will spend thousands to feel strategic long before they spend thousands to become strategic. That is vanity disguised as planning. The internet sells vanity every day. Real planning is uglier. Real planning says not yet. Wait until the surplus is real. Wait until the administrative burden has room to breathe. Wait until the wage can be justified honestly and the excess earnings are not imaginary. The phrase reasonable compensation also deserves more respect than it gets. Many owners want a fixed formula because formulas calm frightened people. They want someone to say 30%, 40%, half, whatever. They want certainty because certainty feels like safety. But life does not owe you certainty. The question is not what percentage sounds pleasant on a podcast. The question is what amount would ordinarily be paid for like services by like enterprises under like circumstances. That is an ugly sentence. Good. Ugly sentences often protect you from expensive fantasies. The compensation should be tied to the value of the services, not to your greed, not to your wish list, and not automatically to a fixed slice of profits. As profits grow, distributions can grow faster than wages. But that does not mean you may treat the wage line like a dying houseplant. This is what I mean when I say the self-employed must become colder than employees. Employees can drift. Owners cannot afford to. The third real lever is the one people think they are already pulling when they usually are not, deductions inside the business that actually reduce the net earnings tied to the same taxpayer. S active business. That sentence is not sexy. It is valuable. Most people hear deductions and mentally drift into a fog of lunch receipts, mileage logs, laptops, home office arguments, and random end of year purchases they barely needed. That is not what I am talking about. I am talking about understanding which deductions and structures actually reduce the active business income base in a way that matters to the toll road. Retirement plans can matter properly, run accountable plans can matter, health insurance arrangements can matter, depreciation can matter, certain benefit structures can matter, but only when they are implemented correctly, tied correctly, supported correctly, and attributed correctly to the business activity that is actually generating the self-employment earnings. Do you see the pattern yet? The difference between a fake strategy and a real one is that the real one requires precise attachment to the actual source of the problem. This is why amateurs stay busy and professionals get results. Amateurs collect ideas. Professionals trace flows. Now let me step away from the mechanics and talk to you about the psychological damage, because money problems are never just money problems. A self-employed person who misunderstands this tax starts to feel punished for effort itself. That feeling is dangerous. When a worker receives a salary with withholding already baked in, the tax pain is muted. When an owner receives gross revenue, pays expenses, fights for clients, does the labor, handles the chaos, and then sees both income tax and self-employment tax hit with no protective fog, the emotion is different. The person begins to feel that every extra dollar earned is somehow cursed. That is when one of two bad things happens. Either the person starts avoiding growth because growth feels like punishment, or the person starts chasing aggressive nonsense because legitimate planning feels too boring. Both reactions destroy long-term wealth. You cannot build freedom while resenting the engine that produces it. And you cannot build freedom by lying to yourself about what kind of income you actually earn. If you want my version in one sentence, it is this: the self-employed do not become wealthy by pretending labor income is capital. They become wealthy by using labor income intelligently long enough to convert part of their world into capital. That is the real transformation. First you work, then you route, then you preserve, then you own. Most people try to skip the routing step, and that is where the whole empire leaks out. Let me make this more physical. Imagine every dollar you earn from self-employment as a truck entering a toll highway. If you are sloppy, every truck takes the main road. Full visibility, full friction, full confusion. You earn, you spend, you panic, you improvise, you discover the bill later. That is how ordinary people live. Strategic people design exits, side lanes, and lawful reclassification. Where the rules permit it, they do not erase the road. They do not fantasize that the toll does not exist. They study where labor ends, where ownership begins, where timing changes economics, and where administrative cost overwhelms savings, that is capital allocation. And capital allocation is what I have always cared about. Not noise, not pride, not the ego of feeling clever. Capital allocation. A great many self-employed people do not have a tax problem at all in the way they describe it. They have an allocation problem. They are earning active income on a toll road, spending too much of it like it is free cash, under-reserving for the gates they know are coming, using the wrong structures too early, and confusing internet theater with tax engineering. That is not oppression. That is disorder. Disorder is expensive. Now I want to talk about one of the most costly confusions in small business life. People think lowering taxes is the goal. It is not. The goal is to increase after-tax wealth without lying to yourself, crippling the business, or creating a future mess bigger than the current bill. Those are different goals. A person can lower taxes and still become poorer. A person can chase deductions and still destroy optionality. A person can buy assets for the write-off and still drown in bad cash flow. A person can force an entity election too early and still add net friction to the whole operation. This is why the self-employed need a harsher internal scorecard than employees. If you work for yourself, nobody will automatically save you from category errors. Nobody will whisper. That deduction helps income tax, but not the self-employment piece you are obsessing over. Nobody will say, this entity is legal clothing, not tax alchemy. Nobody will say, you are trying to use one spouse's losses to emotionally comfort the other spouse. Labor toll. Nobody will say, your S corporation savings are tiny, but your compliance burden just tripled. You need to become that voice. That is the price of independence. The crowd loves freedom as a slogan. Almost nobody loves the accounting that freedom requires. Now, I want to force one more contrast because it will sharpen your thinking. Salary versus self-employment is not just a question of where the money comes from. It is a question of who gets surprised. Employees are surprised by layoffs. The Employed are often surprised by taxes. Investors are surprised by markets. Owners must aim to eliminate surprise wherever lawfully possible. That is what planning is, not magic reduced surprise. If you know the labor toll exists, you reserve for it. If you know active income is the trigger, you stop pretending random unrelated moves solve it. If you know real estate is primarily doing something else, you stop forcing it into the wrong job. If you know an LLC is not a tax identity by default, you stop worshiping paperwork. If you know an S corporation only helps when there is real room between reasonable compensation and total profit, you stop electing on hope. If you know deductions only matter when they are tied, structured, and implemented correctly inside the right business for the right taxpayer, you stop playing receipt theater. That is how adults build after-tax wealth, not by being dramatic, by being exact. And let me say something unfashionable. There is dignity in paying some tax. I know that sounds odd in a world full of screaming tax content, but hear me carefully. A tax bill can be a sign that something valuable happened. Profit existed. Labor had value the business produced. The road was used. The goal is not childish tax nihilism. The goal is intelligent routing. The goal is to avoid overpaying, not to turn every gain into a moral grievance. When people become emotionally allergic to taxes, they become easy to sell. That is when the worst advisors and loudest entertainers feast on them. They promise clean outcomes in messy situations. They market absolutes in a field governed by facts and circumstances. They treat nuance like weakness because nuance does not sell fast enough. I have no interest in selling you emotional sugar. I would rather give you a durable frame. Here it is. Ask first, what kind of income is this, really? Ask second, whose income is it really? Ask third, is the pain I am trying to solve an income? Tax pain, a self-employment tax pain, a payroll tax pain, a cash flow pain, or a timing pain? Ask fourth, does this move actually change the character of the income, or does it simply make me feel like I did something? Ask fifth, is this the right stage of business for this structure? If you start asking those 5 questions, your financial life will immediately become more dangerous to lazy advisors and more profitable for you. Let us run the whole road once more so there is no confusion. You start self-employed, you discover that the labor toll feels brutal because both halves that used to be split and hidden now show up under your name. You realize active income is the trigger, not entrepreneurship as a vibe. You stop believing that buying unrelated rental property retroactively changes the self-employment tax on existing active business profit. You stop pretending an LLC by itself is a tax transformation. You stop confusing joint, return storytelling with person-specific self-employment tax calculation. You begin to see the few real levers. A true limited partner situation can matter because return on capital is different from pay for services. An S corporation can matter if there is enough profit, enough substance, enough administrative discipline, and a truly reasonable compensation framework. Real deduction planning inside the business can matter when the deductions actually reduce the relevant active earnings base for the relevant taxpayer and are implemented correctly. This is not a buffet, it is a narrow bridge. And narrow bridges are where serious people separate from hobbyists. Now, I want to talk about the system shift because the point of understanding self-employment tax is not merely to lower one line on one return. The point is to change how you think about building wealth from self-employment altogether. If you remain forever on the labor toll road, you can make an excellent living, but you will always feel the meter if you route intelligently. Build reserves, price your services correctly, and convert part of your output into ownership systems, teams, retained capital, and assets that are not 100% dependent on your body being present. The road changes at first. You are the driver. Then you become the route planner. Then you try to own some of the road. That is what mature wealth building looks like. Not just lower tax, higher control, not just more deductions, better character of income, not just a smaller bill this year, a stronger structure for the next 10. This is why I despise the phrase save on taxes when it is used by people who have no model of the whole machine. Taxes are one output. Structure is the deeper issue. A mediocre structure with slightly lower tax can still leave you fragile. A strong structure with appropriate tax friction can leave you rich, calm, and mobile. Mobility matters because a self-employed person without mobility is just an employee with worse withholding. Read that again. A self-employed person without mobility is just an employee with worse withholding. If all your income requires your labor, if all your profit is active, if all your planning is reactive, if all your reserve habits are sloppy, and if every April feels like a home invasion, then you have not built a business. You have built a stressful job with a different logo. That is not freedom. That is self-inflicted payroll chaos. The escape path begins with honesty. Price the tax into the business instead of treating it like betrayal. Reserve cash before the year end instead of acting shocked later. Do not over-romanticize entity choices before the economics justify them. Do not mistake content consumption for tax planning. Do not buy assets to solve problems they do not actually solve. Do not pretend every deduction touches the toll you hate. Do not let your emotions design the road. And if the business is growing enough that an S corporation truly belongs in the conversation, treat it like engineering, not folklore. Run the math. Understand the wage issue. Understand the burden. Understand the compliance. Understand the profit spread. Understand that timing is a weapon. Too early can be almost as foolish as never. If you are in a structure where limited partner treatment is truly relevant, treat it with legal seriousness, not as a phrase to borrow from someone else's deal. The law does not owe you the result just because you enjoyed hearing it. If you are doing deduction planning, stop chasing random expenditures and start studying whether the move actually reduces the relevant base lawfully and in substance for the taxpayer who earns the active income. That is what deliberate people do. They turn drama into categories, then they turn categories into decisions, then they turn decisions into retained capital. Retained capital is the whole game because retained capital becomes optionality. Optionality becomes negotiating power. Negotiating power becomes calm. Calm becomes better decisions. Better decisions become compounding. Compounding becomes the thing ordinary people call luck after they ignored it for a decade. And yes, part of that compounding comes from not being an idiot on the tax road. I do not mean that as an insult. I mean it as a liberation. You do not need genius here. You need clarity. You need enough discipline to stop decorating the car and start mapping the highway. Now, I want to end where most people should begin, with one personal test. Ask yourself this question tonight and do not lie. Are you trying to lower taxes or are you trying to feel clever? Because those are not the same mission. If you are trying to feel clever, you will keep collecting shiny moves that sound rich and produce little. You will form entities too early. You will brag about real estate that did not solve the active income toll. You will talk about write-offs with the energy of a man buying expensive bait while his boat leaks. If you are trying to build wealth, your behavior changes immediately. You will identify the true toll. You will reserve for it. You will stop chasing mismatched solutions. You will respect the few levers that really change outcomes. You will wait until the facts justify the structure. You will view every dollar after tax as capital to be routed, not permission to relax. That is the door. On one side is the self-employed life most people live. High effort, dirty bookkeeping, constant surprise, chronic resentment, April panic, entity confusion. Deduction theater, a business that makes revenue but never creates calm. On the other side is a much colder life. You know which road you are on, you know where the tolls are, you know which exits are real, you know the difference between labor and capital, you know when to install more structure and when to leave things simple. You stop buying stories and start buying control. That second life is harder in the short term because it requires ego sacrifice. You have to admit that a lot of the advice you wanted to believe was comfort food. You have to admit that some moves you admired were either mistimed, mismatched, or misunderstood. You have to admit that being self-employed does not automatically make you strategic. But once you admit it, you gain something far more valuable than a slogan. You gain the map, and a person with a map eventually pays less, keeps more, and sleeps better than the person with 10 hacks and no idea what road he is actually driving. The toll road is real, the meter is real, the pain is real, but so is the escape if you stop chasing tax theater and start building a structure that knows the difference between work, ownership, timing, and truth. That is your test. You can keep telling yourself that the next shiny trick will save you, or you can become the kind of operator who knows exactly why the bill hurts, exactly which levers are real, and exactly when you have earned the right to pull them. One path gives you motion, the other gives you control. Most people choose motion because motion feels productive. I would choose control every time.